Bearer bonds. Bonds not registered in the name of the owner. Bond certificate. A legal document that indicates the name of issuer, the face value of the bonds, the contractual interest rate and maturity date of the bonds. Bond indenture. A legal document that sets forth the terms of the bond issue. Bonds. A form of interest-bearing notes payable issued by corporations, universities, and governmental entities. Callable bonds. Bonds that are subject to retirement at a stated dollar amount prior to maturity at the option the issuer. Contractual interest rate. Rate used to determine amount of cash interest the borrower upon the investor receives. Convertible bonds. Bonds that permit bondholders to convert them into common stock at the bondholder's option. Current ratio. A measure of a company's liquidity, computed as current assets divided by current liabilities. Debenture bonds. Bonds issued against the general credit of the borrower, also called unsecured bonds. Debt to total assets ratio. A solvency measure that indicates the percentage of total assets provided by creditors, computed as total debt divided by total assets. Discount. The difference between the face value of a bond and its selling price when the bond is sold for less than its face value. Face value. Amount of principal the issuer must pay at the maturity date of the bond. Long-term liabilities. Obligations expected to be paid after 1 year. Market interest rate. The rate investors demand for loaning funds to the corporation. Maturity date. The date on which the final payment on the bond is due from the bond issuer to the investor. Mortgage bond. A bond secured by real estate. Mortgage notes payable. A long-term note secured by a mortgage that pledges title to a specific asset as security for a loan. Notes payable. Obligation in the form of written notes. Premium. The difference between the selling price and the face value of a bond when the bond is sold for more than its face value. Registered bonds. Bonds issued in the name of the owner. Secured bonds. Bonds that have specific assets of the issuer pledged as collateral. Serial bonds. Bonds that mature in installments. Sinking fund bonds. Bonds secured by specific assets set aside to retire them. Term bonds. Bonds that mature at a single specified future date. Times interest earned ratio. A solvency measure that indicates a company's ability to meet interest payments, computed by dividing income before income taxes and interest expense by interest expense. Time value of money. The relationship between time and money. A dollar received today is worth more than a dollar promised at some time in the future. Unsecured bonds. Bonds issued against the general credit of the borrower, also called debenture bonds. Working capital, a measure of a company's liquidity, computed as current assets minus current liabilities. Explain a current liability, and identify the major types of current liabilities. A current liability is a debt that a company can reasonably expect to pay from existing current assets or through the creation of other current liabilities, and within 1 year of the operating cycle, whichever is longer. The major types of current liabilities are notes payable, accounts payable, sales taxes payable, unearned revenues, and accrued liabilities such as taxes, salaries, and wages, and interest payable. Describe the accounting for notes payable. When a promissory note is interest-bearing, the amount of assets received upon the issuance of the note is generally equal to the face value of the note. Interest expense accrues over the life of the note. At maturity, the amount paid equals the face value of the note plus accrued interest. Explain why bonds are issued, and identify the types of bonds. Companies may sell bonds to investors to raise long-term capital. Bonds offer the following advantages over common stock: stockholder control is not affected, tax savings result, and earnings per share of common stock may be higher. The following types of bonds may be issued: secured and unsecured, term and serial bonds, registered and bearer bonds, and convertible in. Prepare the entries for the issuance of bonds and interest expense. When companies issue bonds, they debit cash for the cash proceeds and credit bonds payable for the face value of the bonds. The account premium on bonds payable shows a bond premium. Discount on bonds payable shows a bond discount.